Hey, what's going on, everybody? So, thanks everybody for being patient. I thought I was going to have to move it to 30 minutes after the market closed, but we are good to go now. So, first things first, for those of you that have listened to these before, you typically know I'm going to review the overall price action for the day and then the 5 minute chart, and then I will answer questions with the little bit of time that we have. I discuss in the trading room on the Brooks Price Action website, typically twice a week, most of the time. In other words, just about every week, that will be Tuesday and Fridays. So if you want to ask questions, feel free to also join the trading room and you can ask questions there. I will try and answer questions here, but with it being at the end of the day, the time gets a little bit pressed. But there doesn't look to be too many questions, so I'll try and crank out a few of them. Overall, one of the first things I do whenever I'm looking at the market, and by the way, I've got my chart over here and StreamYard over here, so you're going to see me look back and forth. One computer is linked up. There's two computers linked up to a wide monitor. So one of the first things I always do whenever I'm reviewing a day is I'm going to mark the open, and that is way too. Let's fix that. So I'm going to mark this. Here's the open. Next thing I will do, I'm going to look for yesterday's low, which is down here, as well as yesterday's high. Now, why would I want to paint yesterday's low and yesterday's high? Because the market will often test one of those in the day, and sometimes it'll test both. But more often than not, it's at least going to break one extreme. And the reason for that is most days are not inside days. So the first thing we knew, if you read the blog post I wrote this morning, one thing I mentioned on the daily chart was this. We had several consecutive bull bars today. There we go. So we had several consecutive bull bars over the past couple of days. 1, 2, 3, 4, 5, 6, 7 bull bars in a row. And that's really not that common. So typically, when you see, you can always kind of make the joke of, I don't really like gambling or playing at casinos, but if you ever played the game roulette with the wheel and you've got, half the spaces are red on the wheel, half the spaces are green, excuse me, half the spaces are black, half are red, and there's two green slots. Well, whenever you have, it's the same logic here. Whenever you have X number of bull bars in a row, the probability becomes less and less that the following bar is going to be a bull bar. In other words, here, the odds were that we were going to get a bear bar either today or tomorrow. The other thing I mentioned was this doji right here. I mentioned that's a trading range bar. And I said a lot of this yesterday in the room. When you have a doji after in a breakout, especially when it's late in a breakout, it's pretty common for the market to break above the doji and pull back. And that's because on a smaller time frame, this whole thing is a trading range. So we had a trading range here, we broke above it, we pulled back within the range, and now we're going sideways. 5 minute chart. So again, one of my thoughts was the open of the day might be a magnet. It probably would be a magnet. I mentioned that on the blog, but also mentioned that we were probably going to close below the open of the day. So let's get to bar one. I typically don't like the bars this scrunched. That's good enough. Okay, so here is bar one. Bar one is a bull bar closing on its high. It's a strong enough bar. It'll probably get a small second leg up. It's following a breakout here, but it's also three pushes up 1, 2, 3, or 1, 2, and then 3. You can call it a bull breakout of a channel if you want. There's the break. There's the channel. We broke above it. Maybe this is the top of the channel, but either way, there's probably sellers above yesterday's high. Bar one typically is not the low of the day. Therefore, 20% chance bar one is the low. And then look at two, completely overlapping one. Whenever you get overlapping bars 1 and 2, that also increases the chances that the market's going to go more sideways, and it increases the chances that the day is going to be a trading range. 3, inside bar breakout mode, probably buyers below, sellers above. And then 4, we're breaking out above the 3 bar tight trading range, probably sellers above 4, as there were sellers above 1, sellers above 2, sellers above 3. We're probably going to pull back. Now, we didn't obviously trigger the sell above 1 and 2. We did on 4. And then 5, we have a doji. Not a great looking breakout. We might go a little bit higher, but to me, this looks like a failed breakout above yesterday's high, and it looks like we'll probably pull back. 6, testing back into the range. Strong enough bar on 6, we may get a small second leg down, but not clearly breaking out. Plus, we're holding above the moving average, and we really need to get a breakout below the moving average with follow through. And there's the breakout, and that's a decent bear bar. Strong enough bar, probably going to go at least a little bit lower. I typically call these always in flips. So we were always in long up here, although it wasn't ideal. And this big bear bar flips the market to always in short. So the odds are we're going to get a second leg down. My only problem with selling here is you're selling right at yesterday's close, right here. So this could just be a sell vacuum test of yesterday's close. Now, if you are selling here, you have to be prepared for a deep pullback, a test of the 1 low, maybe a test of the bar 6 low. And then you see bar 8, a big bull bar. Do you buy above 8 betting on a failed breakout below 1 and 6? Some traders might. I don't think it's that great of an idea. And the reason is there's probably sellers above 8, although 8 is probably strong enough for at least a small second leg up. So we may rally, deep pullback, second leg, and then go down. So in other words, 1, here's the bear breakout, 2-legged pullback, second leg down. Bear bar 9, but a decent rally from the 8 low to the 9 high, probably buyers below 9. And then you can see what happened on 10. 10 tested the bar 7 close. I've mentioned several times that low 1 shorts are bad, or typically a low 1 short is a test of the extreme. A high 1 buy here is a test of the extreme. Most of the time, when you test the extreme of a breakout, you typically find sellers, or you find profit taking. So what I mean by that is bears who sold the 7 close, disappointed with 8. What are they going to do on a retest? They're going to look to buy back shorts around their original entry price. That's what will create a second leg up, or that's what will create buyers. Now, when you have a strong breakout, something like this is technically a high 1 buy, bar 15. On some time frame it is. But this breakout's so strong that if you're a bull and you bought the high take of 14, are you really going to panic when you see 15? Of course not. If anything, you're buying more on any pullback. Therefore, we got a second leg. Here, it's not the same. Trading range, breakout. We may be forming a trading range here. That's why there's buyers below 9. 10, high 2 buy, but look what happened to the bulls who bought the 8 close. Bulls buy the close, buy more lower, getting out break even. 11, decent bear bar, closing near its midpoint. What about selling the close of 11? I would not. We still may go a little bit lower, but chances are we're probably not going to go that much lower. But we could still easily fall to the 78 low. We have a spike pullback channel. Targets are the 78 low or the 37 low. Just want to check something. $12 inside bar, probably buyers below, sellers above, possible final flag. And then you can see 13 an outside bar, so forming a trading range, possible wedge, 1, 8, and 11, but a tight bear channel, probably sellers above. We could easily test the 9 high, which is the start of the channel. Spike, pullback, channel. Channels typically evolve into trading ranges. And then 14, bear bar, but failing to close below these lows. Not clearly always in short. It is short, but it's not all that great. And then 15, we have a bull bar. So we have a spike, pullback channel, bull bar closing on its high with 15. What about buying above 15? Well, the only problem with buying above 15 is it really overlaps a lot of bars to the left. And you're in essence buying in the middle of a trading range. So when you see this right here, this is a spike pullback channel on a smaller time frame. I like to look at 100-second charts pretty regularly. 100-second chart is divisible by 5. Therefore, if you look at a 100-second chart, you will notice that every there's 3 bars for every 5-minute bar. Fortunately, TradeStation gets mad when I do a 200-second chart. So here's a 2-minute chart, and this is what I'm trying to show. We had a we had a spike, pullback, and a channel. And that big bull bar, let me see if I can do it like this. TradeStation did not like me doing that. Okay, so here is the spike and channel. See this rally up to 11.18? That's this bull bar right here. Actually, I went too far. That's right here. That's this rally right here. So do you really want to buy? You can't even see it. Let me move myself out of the way. This bull bar right here is the equivalent of this rally right here. Here's the rally. And because of that, this is a very tight channel with a lot of overlap. It's the middle of the trading range, so it's not really a great buy. That's why Al says in the books, buying above stop entry bars that overlap a lot of the bars to the left is typically buying high in a trading range. So if you're buying high in a trading range, you need the context to support the entry. Here, context isn't great. Oh, it's a wedge, but tight channels typically evolve into larger wedges. 16, a bear bar, so we sold off. Bulls bought the breakout 15, and they bought more lower. So what do you think is going to happen on the 15 close? There's probably going to be sellers around the close of 15. We rallied. So we rallied up to the 15 high. We pulled back to the 16 low. It's a major trend reversal in a smaller time frame. Rally, pull back, bulls scale in. They're going to look to get out maybe at the high close if they're disappointed. And that's what happened on 17. 17, bear breakout, a little bit of a surprise. May go a little bit lower. 16 is a low one short. So some of the traders, they sold the 14 low right here, scaled in higher. And the question is, what are these traders going to do down here? And it looks like a lot of those traders ended up getting out. They tried to get out. Some of them got out break even, but this is a strong enough bar. We could easily go a little bit lower because it's a wedge 1, 2, 3, or it's possible failed breakout of a wedge. Here's 3 pushes. Here's the failure. We could easily reverse back up. So selling the 17 close right here is kind of like buying the 15 close up here. It's really not ideal. 18, 3 consecutive bear bars, still probably buyers below. 19, an inside bar. It's a breakout mode bar. You can argue we may get 2 legs up, but the channel's tight and we're holding below the moving average. Whenever you have a tight bear channel and bulls are not making money, you have to always consider the opposite, a bear breakout of a bear channel. 20, bear bar, probably buyers below 19. And then we have a bull bar 21. For the bulls, they hope it's a second leg that leads to a test up to the 8 high. And 22, we have another bull bar. Some traders, they buy above 8, they buy more above 21, get out break even here. They assume 60% chance we're going to test up to the 8 close. And then instead, what do you see? What happened on 23? Well, 23 is breaking below a wedge. And when 23 breaks below a wedge, everybody starts to question if we're going to get a measured move down. 24, bull bar, possible failed breakout of a wedge. But to me, 23 is a big enough bar. We're probably going to get at least a small second leg down. 25, doji, probably going at least a little bit lower. 25, doji, probably buyers below 20. There's probably buyers below 25, but again, because of 23, I suspect we'll get a second leg down. Then 26, inside bar, probably buyers below scaling and lower. 27, bull bar, completely overlapping the prior bars. We're still forming this tight channel, but we could easily break out below and get a second leg. You can see what's happening. The bulls who bought the 22 low right here, they're disappointed with 26, disappointed with 25, 26, 27, and we're finding resistance up here. And then we broke above it and we turned down. So what happened? You had a lot of bears. Let's consult the 1 minute. Let's consult the 2 minute chart. It'll be easier to see. So what happened here? We had bulls buying all the way up. And then we see that these bulls who bought hoping for a second leg up, they got trapped with this bar. So what are they going to do on a retest? They're probably going to look to sell. And that's why this happened. 28, bear bar. You can call it an implied low too short, but it's a micro channel since the 23 low. Low probability sell, but low probability does not mean no probability. 29, breakout and then a pullback, but forcing traders to buy in the middle of the tight trading range, not ideal. And then 30, where it looks like we're breaking out even further. So 30, now we're getting a bear breakout below a possible wedge. Here's the measured move target from the high of 5 to the low of 7. The other target has already been hit right here. The open of 6 to the close of 7. Possible exhaustion bar on 30. But whenever you have a channel and you break below the channel, especially when a lot of the left is a trading range, you can break out to the downside rather quickly. 31, follow through, probably always in short, but this is a bear breakout late in the trend. We may get a measured move from here, so it's possible this was the breakout of the channel. Here's the channel. It's possible we broke out on 23 and 28 is a deep pullback, and this is the second leg. And you can see we crashed below that. So other traders will begin to question if this is going to be the actual measured move projection. 31, 32. Now we have three consecutive big bear bars. This is pretty climactic. And we're getting near yesterday's low, this blue line. When you see a climactic bar like 33, a lot of traders begin to take partial profits because they know that the risk is traders will begin to buy back their shorts. 33, inside bar, probably buyers below 33 and sellers above 33. But again, it was reasonable for bulls to buy the 23 low. And since it was reasonable to buy the 23 low, you know there will be traders who bought and scaled in lower. 34, inside bar, probably buyers below. And then 35, now we have three consecutive bull bars, probably buyers below 35 for a second leg. And then you can see we broke below 35 and we pulled back. So it's a low one short. Some of the bears who sold the 32 close and more higher, they're so disappointed that they may look to buy buy back their shorts for a loss. They buy here, they scale in, they try and get out near break even. Maybe they get out with a small loss. 37, doji. You can see we went lower, but still finding buyers. And then 38, big bull bar. Strong enough bar, probably going to this line up here. The area where the bears got the breakout, probably going to reach the moving average. Doji 39, so we rallied, pulled back once again, probably buyers below 39. There might be sellers above and we go sideways, but I think this is a strong enough rally. We're in a large trading range. 40, Doji, probably sellers above 39 and sideways. And then 41, it's forming a double bottom with 39. Now this is a small breakout mode pattern. 42, you can call it a wedge or double bottom. We went down and up, and then down and up. For the Bulls, it's a two-legged pullback after 38. They want a second leg or a third leg up to the red line, the 23 low. So they want one, two, and then three. And then we got a strong bull bar on 43. Is 43 by the close? It might be. It's breaking out above the moving average, which is good. But the middle of the bar is breaking above the moving average. And it would be better for the Bulls if they can get a follow through bar. The next target for the Bulls is going to be probably it's either the high of 26 or the high of this bar up here, the 25 high right here. Let me fix this chart. There we go. Follow through on 44, but weaker follow through. Sign of hesitation. And you can see what happened. We rallied up to the 30 high and immediately found sellers and pulled back. Increases the odds that we will get a pullback. It's possible we have to test the 40 high right here. And then we got a surprise bar on 45. 45 strong enough bar that some of the bulls who bought and scaled in, they're going to be so disappointed that they will look to exit. Why would they look to exit? Because they think there's going to be a second leg down. And if there is going to be a second leg down, a lot of those traders, instead of holding for that second leg, they'd rather get out on the bounce and then buy lower. 46, three consecutive bear bars, probably going at least a little bit lower. And look what happened on 47. 47 tested near the close of 41 and then reversed up sharply. The reason why 47 went outside up is the rally up to 44 was strong enough for a second leg, and we went outside up. And a lot of those traders who were buying and scaling in lower, they knew the odds favored a second leg. The other thing to think about is the high of 12 o'clock, bar 30. The high of the bar is 91 and a half, and the high of 44 is 91 and a half. It's common in trading ranges for the market to test a price level, get a deep pullback, and then break above it. So chances are we're going to go above the 30 high. Outside up 47, we may get a small pullback, but chances are 47 is a strong enough bar for at least a small second leg. 48, bull bar testing the close of 44, but decent retest. If we do get a pullback, it's probably limited. And then 49, now we have three consecutive bull bars. For the Bears who sold above 46, hoping for a second leg down, they saw 45 and 46 as being strong enough for that second leg and maybe a test of the 42 low. In other words, they were hoping for a major trend reversal. Strong bear breakout, deep pullback. There's the trend line break. Next, they wanted a test of the lows and the market to form a double bottom. Ultimately, if the Bears were really lucky, the Bears want to trap the Bulls. So, kind of like this a big bear bar like 23. They want 45, 46, and 47 to be another big bar that would squeeze out all these eager bulls buying. But chances are that will not happen. So if you're a bear and you sold the high of 46, you're trapped on 47 and you're hoping for a second leg down, but then you see 48 consecutive bull bars. A lot of those bears might try and give up, betting that the market is not going to pull back that much more. And then we have another bull bar 49 and then 50, another bull bar. So the bears hoping for the second leg after 46, they're now trapped into a losing position. And therefore, there's probably buyers on any pullback. 51, another bull bar, but we're starting to get overlap and we're close to this target right up here. We may go a little bit higher, but chances are we'll probably pull back soon. 51 outside down, starting to form a trading range. This is a strong breakout, but then sideways trading, which is not ideal. And then 52, we have an inside bar. There might be sellers above 52, but tight bull channel, odds are we'll get a second leg up. And what do you notice right here? All these closes of these bars and the close of this bar, this might be a really small gap. It's basically a negative gap, but it still operates the same way. There's a slight gap, and that would be a measured move projection. Other traders will look at it as we had a bull breakout of a bear flag. So here's the bear flag. We broke above it fairly strong. We tested the breakout point, but the bears still failed. And then we broke to the upside. So because of that, that will increase the chances that we test up to the 28 high. 54, second leg down after 52. So we went down on 52, up on 52 and 53, then down on 54. If we were and we reversed up. If we break to the upside, that would be a bull breakout of a two-legged pullback plus an open gap right here. And then, no surprise, 55 broke out to the upside. Strong enough bar, we may go a little bit higher, but it failed to close above the 28 high. And we're right near the middle of the day's range. We had a large sell off, deep pullback. Typically, when you get a big sell off and deep pullback, you go sideways and you do not reverse. Therefore, the odds are against probably something like this, a measured move up of some sort. 55 is a strong enough bar that we may get a small second leg up, but we probably will not go much higher. And then 56, bull bar, but closed at the 55 high. Let's see, it actually might have closed slightly below it. The high is 96.75, closed 96.75. So it closed at the high. It'd been better for the bulls if they closed above it. And then we got a bear bar on 57. 57, bear bar, probably buyers below, but the size of the bar, 57, will probably limit the upside. Some of the bulls who bought up here, they'll scale in lower, disappointed, and they'll look to exit around break even. 58, inside bar. With all these tails, I think the market's probably going to go sideways. May have to test the breakout point down here. And then 59, testing the high close of 56. Bad high one above 58 right here. That will limit the amount of traders buying above it. And then 60, another doji. And then look what happened on 61, outside down. So the bears are beginning to make money selling above bars. Typically, when the bears begin to make money selling above bars, the market starts to go more sideways. And then what happened on 62? 62 is a big bull bar reversing up. So all the bears who sold this outside down bar, hoping that this was the start of a bear trend, they were disappointed, just like the bears who sold here, hoping it was the start of a bear trend. They were disappointed. We had two legs down and a big bear bar. Whenever you get a big bar, it forces traders to sell low in the range. And when the market forces traders to sell low in the range, usually it goes more sideways and possibly reverses. And all of these sell-offs, they basically form parabolic wedges on smaller time frames. It's always hard to see it, but you can infer it. So if I look at this big bear bar, 61 at 1435, hard to see, but big bear bar, pause, big bear bar, second leg down. We basically sold off, pulled back, and got a second leg down. And then we got a deep retest here and a test of the lows. That's a major trend reversal. Fix this chart. So bull bar 62. What about buying above it? Some traders will, but I suspect we'll go more sideways. Big bear bar, big bull bar. Bears are trapped and the bulls are being forced to buy high, so it's not really ideal. Plus, this gap closed. And when gaps start to close, that increases the chances that the market will go more sideways. 62, we sold off and then rallied. So some of the bears who sold the 61 close, disappointed with 62. They scaled in higher, and then 63 retested the 61 close. 64 inside bar, probably buyers below, scaling in lower. And then you can see 64, excuse me, 65. We tried to break below the inside bar, which is basically a triangle, and then we reversed up on the very next bar right here. 66, bear bar, second leg down. It's a possible wedge for the Bears, down on 57, up, down on 61 or 62, up and then down on 66. 67, bull bar, inside bar, probably buyers. Are there more buyers or sellers above the bar? We'll probably go mostly sideways. It's tight trade. It's a tight trading range. You can call it a tight channel, but it's basically a fairly tight range. And with the micro channel from 63 all the way to 66, that will probably limit the amount of traders buying above it. And then we got a bear bar on 68. Low one short, spike, pullback channel, probably buyers below. And the bulls got a second leg up on 69. What about selling above 69? I would not. It's a second entry buy, and that will increase the probability that the market goes at least a little bit sideways to up, and we may test the high of 62, the start of the channel. 70, doji, 71, another bull bar. We're testing right up to the top of this channel, and this is a trading range. For the bulls, it's a spike, pullback, and a channel to the upside. The bulls still have targets above. Other traders will see this as a very tight bull channel. So you can draw it, somewhat like this. We broke the trend line. We're retesting the highs. Traders will pay attention to see what kind of upside breakout we get. 72, another bull bar, and then 73, a big bear bar. What do the bears do here? It's a disappointment bar on 73. And because of the bar being disappointing, 72 is retesting the closes over here. And you can see a lot of bulls took profits. That's what 73 is telling you. Now, is 73 a sell the close bar? No, it could just be a sell vacuum test of support, and bulls immediately buy it. And that's what happened on 74. 74, trapping the bears who sold the close of 73. The bulls, they want an upside breakout, and the bears, they want a failed breakout. I still think we're holding above the moving average. We could easily get the upside breakout. 78, strong bull bar. So a vacuum test at the open of the day. And then the market basically went sideways for the rest of the day. Well, actually, it pulled back, but it went sideways. Whenever you get a buy climax late in the day, usually that leads to profit taking, especially when it's at obvious support, yesterday's high and the open. But you can see the bears accomplished the minimum. The bears got a bear bar on the daily chart. Stop entries, not really any great ones here. Maybe you sell below 9. That's a low one short after a big bull bar. I would not. And that really means all through here, it's pretty difficult. There's not a great stop entry sell. You can look at smaller time frames and look for a rally and then look for the rally to pull back and then sell. But that's still not that easy of a task. And then I thought it became clearly always in short 31, 32. But if you sold there and then you see a big bar like 30 and 31, clearly always in short. But then you see a big bear bar like 32, probably going to find profit taking. We rallied up to 35. What about selling below? I would not. And then maybe, I think it's okay to buy above 42. Lower probability, but we're probably going to test the breakout points up here, so it's probably okay. Bulls can buy above 47. And, what about in here? Really not ideal. Maybe buying 67 or 69. And the shorts were fairly challenging. In here, it's a channel, but it's a weak channel. It broke to the downside, but then it retested the breakout points. This is mostly a limit order market. For limit orders, I thought sellers above 3. What about buyers below bar 5? Well, that's not easy. We rallied, deep pullback, rallied, deep pullback. It's a doji. Chances are we're going to fall below 1. Some traders might take it, but if they did and they saw 6, a lot of them would be really quick to get out. And you can see what happened. Bulls who bought the 5 low at 4.75, they scaled in lower, and then they were disappointed by bar 6, and the very next bar 7 went one tick above the 4 excuse me, one tick above the five lows. The bulls buy this low, they scale in lower, disappointed with six. They immediately tried to get out break even at their original entry on seven. And that's why the market sold off aggressively. And then probably buyers below nine, sellers above 10, buyers below 12, sellers above bear bars, buyers below 16, and even buyers below bars like 17. Sellers above 24, but probably buyers below 25. And then maybe buyers below 26. But if you did, look what happened on 20 buyers below 28. But if you did, look what happened on 29. If you bought below 28, 91.25, you're disappointed by 20 bar 29. But then look at the high of 30, 91 and a half. So the traders who bought the low of 28 scaled in lower. They were so disappointed. They thought, darn, this is breaking out to the downside kind of quick. Maybe I should get out break even. And then those traders had one chance before the market sold off. I thought buyers below 35, buyers below 40, even buyers below 44, but the pullback could be fairly deep. And buyers below 51, probably okay to sell above 35 during the bull bar here, but you got to be quick to make decisions. Buyers below 51, buyers below 53. I thought sellers above 58, but hard to do when you have targets above in a tight bull channel. So it's not ideal. And then probably buyers below 68 and maybe buyers below 72, but pretty late in the day. Buy the close, sell the close. Maybe sell the close 7, but right at yesterday's close, probably better to sell pullback. And then probably sell the close 32, maybe 31, definitely 32. You can buy the close probably of 43 or 44, but we've been if you do, you really have to be prepared to probably scale in. But it's a strong enough breakout, we'll probably get a second leg. One of the problems with buying these breakouts is look to the left. So what do you notice about this day? Let's just measure it here. So here is 66 and 33. So here's the bottom portion of the range. Here's the upper portion of the range. And I just took the range of the day so far. And here, excuse me, here is the basically no man's land or that middle of the day's range. So the problem right here with the problem with buying in this area is this is not really where you want to be buying. Where you really want to be buying is down here in this area, and traders want to be selling up here. This is the way traders see a trading range. So why do I have it set up like this? Because the range from this high to this low, chances are we're either in a trading range or we're probably in a trading range if we do get a rally. So when you start to get to the middle of the range, everybody begins to question. Everybody wants to buy in this green box and everybody wants to sell up here. So whenever you have a strong breakout that's in the middle of the range and you look to the left and you see a lot of trend bars, a lot of traders are quicker to get out. And they're not really a fan of buying up here. And for one, because of the risk reward, what's the probability the market goes here before it pulls back? It's not as high as you think. It does favor the bulls, but typically you need to be able to scale in and use a wide stop. So a lot of traders just would rather wait for the pullback. Is it sell to close 46? I would not. After this big bull breakout, probably buyers below, and some point probably buy the close in here, but at a new high, probably sellers not far above. And then once the market started going sideways, the bulls who bought anywhere in here would probably be quick to get out or get out on a second leg up. And then as far as buying up here, I would not. Three pushes up, one, two, three. Chances are we'll probably go sideways fairly soon. And then that's probably it for today. Okay, let me take a look at some questions here. Question: would you guys ever consider selling day passes to the trading room? I can usually only join twice a week, so it's hard to commit to paying $99 for a full month when you only get 40% of it. Well, for one, that's none of my decision. But I know, I've watched the trading room since probably 2013. And the benefit is you get the recordings. And I know the price has always been $99. And it's been there. It was $99 in, I think 2010 or 2009 when it started. And maybe it's 2011 when it really started. So the point is, there's a couple of things with that. One, I know there's a logistical piece. Ken, who operates the website, who really operates all of it, would have to change up a lot of the processing. But overall, what I would consider is, and this is for anybody really, if you're joining the trading room, you have to study. I really recommend studying the recordings as well as during the day. The only problem with watching the trading room live is you're going to be influenced by your own bias. So if I'm watching someone, when I was watching Al in the trading room in, back in 2013, 2014, 2015, and again for years, I watched him. What benefited me the most was really taking the time when the market was closed, pulling up the recording of the webinar and really hearing what he said because there were so many things I'd be thinking about the bars and I'd be totally missing some of the things that Al was saying. So that's my recommendation there. Should traders pay attention to Globex patterns on the open, like a high two buy setup before they open? That can help you. I'll often glance at the Globex market. Whenever you get a big gap, one of the things I'll often do is big gap like right here. One of the things I'll go ahead and do is just take a look at the Globex session. I think we just saw the 30th. Okay, so here is the 30th. And we had this big gap up right here. And this is here's the gap from 38.74. We're in a tight trading range right here. Then we get a big bull bar at 9:30. That does increase the probability that we are going to go higher. But then in hindsight, it ended up being a large, basically kind of like a final flag rally, sideways, upside breakout, deep pullback. But you certainly don't have to look at it. Whenever there's a really big gap, I will sometimes look at the Globex just to see. Because a lot of times, whenever you get let's say you get a reversal, it's really common to get a big breakout after a report. Those reports that typically happen about an hour before the session opens. So the reports that happen at 8:30 Eastern time, when the market opens at 9:30 Eastern time. Sometimes those reports happen, they cause really big breakouts, but it's late in an overall move, and then the market reverses. But you don't need to see any of that. You can see all of that just even looking at the 5 minute or even the higher time frames here. So that's all I'll kind of say with that. But you can certainly look at it. I think it's a mistake. What I think is a mistake is when traders start looking at both too much, because then they won't be able to decide what to do. In terms of practice, should a trader be back testing as much as possible? Should a trader do a bar by bar like this end of day or just pin up the day's price action? Well, there's a few things. One, learning how to become, you have to, I think it's important to take topics of ours and get really good at it. The first thing, swing trading. It's really important to understand what a major trend reversal is. So, what's a major and what's a minor reversal? Can you spot that on a chart? Can you spot a strong breakout on a chart? Can you spot, when are stop order bulls making money, limit order bulls making money? I talk a lot about always in, and I think most traders should think through how to trade always in and really understand that. What a lot of traders do with Al, especially in the Brooks trading course, that messes them up in the short term is they want to study and learn everything. And I'm not saying you shouldn't watch the video course. What I'm saying is you need to watch the video course. But the more you can direct your trading into a couple of setups that you're looking for, and the more you can understand those setups really well, the better off you're going to do. That's why when you hear Al, he talks a lot about beginners should look for swings. Beginners should try and go for twice the risk. Beginners should be very structured in what they're doing because it will increase the chances of them having success faster. If you're trying to do, you're trying to scalp, you're trying to scale in and do all these various pieces, you're going to end up making more mistakes. So as far as what should you do, I think it's a great idea to mark up charts. The first thing you have to get proficient in is reading a chart. Can you stare at this chart and understand all the little things happening? If this is a big bull bar on 21 and 22, why is it a big bull bar? And then why is 23 a big bear bar? And then if 23 is a big bear bar, why did we get all this price action that led to another leg? I talked about that. The bulls, they bought hoping for a breakout. They got trapped on the way down. Therefore, they're going to use any pullback to sell it off longs. But all of that takes practice. Okay, why didn't we get any follow through after 33? I'm not sure what you mean. Why did we not get? Oh, okay. I think I see what you're saying. Why didn't we get follow through selling after this big bear bar 32? Well, there's a few thoughts there. One is we had a spike and then a channel and then a sell vacuum. And very often, whenever you get a big breakout late in the move, 50-50 chance it can just be a sell climax that leads to a reversal. And you can see that's exactly what happened. We had so much buying pressure in here. This is typically not how strong trends begin. Lots of buying pressure in here and then a strong downside breakout. That typically traps traders into doing the wrong thing. But even if you didn't know that, and plus, climactic bar, a lot of traders, I like to think about it like this. If you're short and then you saw this, what are you going to do? If you're fortunate enough to hold short up here, you're going to use this and take your profit. Therefore, if you're taking your profits down here, you're going to wait for 10 bars and roughly two legs before you look to sell again. Why 10 bars and two legs? Because you want to give traders a chance to see how the market responds. Are we going to get a strong reversal up? Or are the bulls going to try several times to get a reversal and then fail? So it's kind of like right here. Instead of bears selling here, which some of them did, bulls start taking profits, but they wait to see how strong the bears are. Bulls aren't going to buy. Bulls aren't going to buy immediately after these bars. They wait for the market to start going sideways, and then the selling pressure starts to erase. And then once the selling pressure erases, bulls start buying again. But then here, a lot of the bears who were selling on the way down, they bought back shorts. Now they know that the selling pressure is there. What are they going to do? They're going to look to sell at new highs. So a lot of traders that took profits here, they look at this rally and they think, gee, this is a problem. It's a two-legged pullback and it looks like a bear flag, but there's so many bull bars and so few bear bars. Maybe instead we're going to get an upside breakout, and that's what happened here. Was the extent of the recovery after the crash surprising? Not really. What they're saying is, was it a surprise that we sold off and then we got a rally here? No, it's just a two-bar reversal on a higher time frame. So if we go to like a 120-minute chart, here you go. Actually, I'd rather maybe go to a 45-minute chart now. 60-minute chart works. We had this big sell-off and then this reversal back up. And there's always reasons, here it's testing breakout points. But the way I look at it is this: we had a big sell off and then a reversal up. So the reversal is reversing the price action. And that's the same thing that even happened, right here. This big bear bar did not immediately form. The sell off began on the prior bar, 22. The market started to sell off. Traders tried to retest the highs, and they ultimately gave up. Can you explain more about the possibilities of the market at bar 31? Sure. So 31, what do we have? We have a spike, pullback, and a channel. And we obviously have a very large trading range in here. So very large trading range. Whenever you have a large trading range and you're near the lows, you always have to respect the possibility of a bear breakout. And the bulls continue to get strong bull bars and they continue to keep failing. And eventually, if we keep going down, what does this create? Creates this. So what does this look like to everybody? It's a bear breakout. So this is the close of 11:30. Here's 11:30. So from the high of this bar to the low of this bar is three bear bars in a row. Three bear bars in a row make it difficult to get a new high without getting a second leg down. So with all this sideways trading, we still had to get the market still had to go, it ended up breaking to the downside. Actually got that wrong. It's really these two bars. Consecutive bull bars increases the odds of sellers above, and then we got the third leg down. An example of a protract. This is a good example. Here's the opposite. Very tight bull channel, and when we look at it, when the bears are not getting selling pressure. I can go to the euro versus the dollar. We're going to see the same thing. Very tight channel on the daily chart. Look what happened here. We broke above the moving average and then we still sold off and went sideways. So the point with tight channels is tight channels take a lot of bars to really break the trend line and prove to everybody that we're in a trading range. Now we're in a trading range, but that can take a long time. Here, we're still forming lower highs and lower lows. So a lot of traders, they'll still view this as a tight channel. So tight channel, they'll still view it as such. And trading ranges like to test lower prices and fail. So they like to break out below things and then reverse up, testing the channel or testing the bottom of the range. Plus, when you see this as a whole, look right here. We had a trading range in here. So we could easily have a rally. Here's a major swing point and then a rally. But this whole thing might just be a channel, spike, pullback channel. Therefore, the bottom of the channel is a magnet. So why did this happen? Because you never know if this is a channel. We had this large sell off, the sell vacuum to at around bar 32 today. And whenever you get a sell vacuum, you never know, as Al always says, you never know how many dollars are sitting on the other side waiting to buy. So whenever you see a sell off, always, if you see bars to the left, you always have to think this could just be a sell vacuum and then we get a reversal up. That does not mean you should be picking bottoms, though. I've got time for one or two more questions here. How, how do you go back and watch the previous live streams from the room? Just go to brookspriceaction.com, log in, click forums, and then you should scroll down and you will see the you'll see the month you're subscribed to. You can click on it and you'll find the recordings. Is it easier for beginners to trade successful breakouts, aka continuation, or failed breakouts, reversals? Most traders should trade with the trend. Most traders should try and find breakouts that are strong enough for a second leg. So what are some patterns of that? Let's look at today. Strong enough breakout, probably a second leg down. So traders can sell, scale in, get a second leg. Where's another example? Well, here, not so. It's pretty difficult because these are all multiple attempts down, and then we broke to the downside. But at some point, pick a place. Here, this is a strong breakout, probably a second leg up. If we go to the prior day, 3 consecutive bull bars, probably buyers below second leg. 12, 13 consecutive bull bars, breaking out of a tight trading range, probably buyers buy the close for at least a small second leg. You see a bar like 28, guess what? You're probably going to get a second leg down. So sell the close at 28, sell above for a second leg. Back testing is useless without knowing what to look for. That's exactly true. Back testing is helpful for understanding. Here's how I would back test. It's really simple. And, for as far as the way I always viewed back testing is this. I'm going to take the Brooks trading course. Al is already explaining a lot about the market and probabilities. Therefore, I don't want to reinvent the wheel. If Al is telling me that there's a 20% chance bar one is the low or the high of the day, that's a good enough probability for me. It's a low probability event. Therefore, I want to back test things that I know are reasonable. So, what are things to back test? Okay. What about when you get a 3 bar micro channel like such? What's the odds of it getting a second leg? Or a 3 bar micro channel here? One, two, three. Where especially when you think it's a strong enough breakout to be a leg one. Here, a little bit different. We're breaking out above the moving average. So what about back testing? Here's an easy one to back test. And how do you back test it? Well, just tally it. Go through days and look for it. So find a breakout above the moving average, a 3 bar micro channel breaking out above the moving average, like so. How often do you get at least a second leg up? Here's a 2 bar. It's really a 3 bar micro channel. One, two, three. How often do you get a second leg down? And you'll find it's actually quite a bit. Here, breakout above the moving average. 1 bar, 2 bars, 3 bars. By the close, you got a small second leg up. One, two, three, 4 bar micro channel, still got a second leg up. 3 bar micro channel here, one, two, three, it got a reversal. So maybe, here's a 3 bar micro channel, but one of the bars was a bear bar. Even if you bought here, which is not really ideal, if you did, and then you got 3 consecutive bear bars against you, now you have a 3 bar micro channel in the opposite direction, closing below the moving average. So maybe you reverse to short and you get a second leg down. So that's the way I think through as far as back testing. And there's a lot of other things that are involved with that, but that's just a simplified example. All right, so tomorrow, what are we going to do? I think we're probably going to go sideways. What happened to all the eager bulls? We had a strong breakout, and now we're going sideways in this range. And there's a reason for that. The reason is traders knew that this reversal, when we started to go sideways here, traders concluded that this is simply a buy vacuum test of this. So all of a sudden, the magnets turned off. We sold off, and then we started to race up, and everybody agreed that we're probably going to test this extreme. But now we're at the extreme, and now the market's deciding: are we going to break above it? Are we going to go above this high right here? Or instead, are we going to pull back down here and test one of these breakout points? These big gaps on the daily chart, they'll probably get filled at some point. I still think the bulls will get a second leg, but the longer we go sideways, the greater the risk we do. The longer we go sideways, the greater the risk of a deep pullback first. But we'll see. All right. Thanks everybody for watching, and I hope everyone has a great rest of their day.